In this week's Property Imperative, we look at the latest economic news, delve further into the bank levy, and discuss recent changes to mortgage lending volumes and pricing. Welcome to the 20th of May edition. Hi, I'm Martin North, the Principal of Digital Finance Analytics. This week, the latest updates from the ABS show that the trend unemployment rate stuck at 5.8%, thanks to a large rise in part-time employment. In fact, employment was up by a very strong 37,400 in April, after increasing by a massive 60,000 in March. But strangely, the total hours worked has fallen by 0.3% in April and was down 0.1% over the past 2 months. Now, this may be because of changes to the ABS sampling. Many commentators suggest the true position is worse. We do know that unemployment was just above 7% in South Australia, and the number of older people seeking work also rose. The latest wages data show that the season-adjusted wage price index rose 0.5% in the March quarter and was 1.9% over the year, according to the ABS figures. This makes a bit of a joke of the strong wage growth predicted in the recent budget. The season-adjusted wage price index has recorded quarterly wage growth in the 0.4 to 0.6% over the last 12 quarters. However, private sector wages rose just 1.8%, whilst public sector wages grew 2.4%, so public servants are doing better than the rest of the population. The pincer movement of higher inflation and lower wage growth means that average wages are falling in real terms, especially for employees in the private sector. Not good for those with mortgages, as interest rate rises flow through. This aligns with our mortgage stress data. There was further heated debate about the bank levy, with the Treasurer saying on ABC Insiders that the impost was a permanent measure and linked to the strong profits and competitive advantage the Big Four have, thanks to the too big to fail implicit guarantee from the government. He again said the cost of the tax should not be passed on to customers. On the other hand, the banks put their own slant on the issue, saying that the cost would be passed on and that the levy was bad policy. Ex-Treasury boss Ken Henry, now the chairman of NAB, suggested there should be an inquiry into the proposed tax and said it looked like something from the 80s before all the free market reform. The banks made submissions to the Treasury complaining about the short time frames and seeking a delay in implementation. ANZ suggested a delay till September 2017 to allow sufficient time for the design of the legislation, and also recommended that the tax should be applied to the domestic liabilities of all banks operating in Australia, with global liabilities of about 100 billion. They concluded, there is no magic pudding. The costs of any new tax is ultimately borne by shareholders, borrowers, depositors and employees. But the real debate should be framed by the excess profits the big banks make and the unequal position the Big Four have thanks to the implicit government guarantee, meaning they can outcompete regional and smaller lenders. And in fact, the value of this subsidy is significantly higher than the 6 basis points being imposed. There are very high stakes in play, and the outcome will significantly impact the future shape of banking in Australia. In fact, you could argue the Big Four receive the largest subsidies of any industry in the country, way more than, for example, the entire car industry. In addition, the Australian Banking Association is caught trying to represent the interests of the Big Four and other regional players, which include some who have supported the tax on the basis it will be helping to level the competitive landscape. The ABA issued a statement to say there was no division, but clearly there is. Not pretty. Some have suggested the smaller players should create their own separate lobby group. The latest lending data from the ABS show that the mix of lending is still too biased towards unproductive home lending at the expense of lending for commercial purposes. Overall trend finance rose 1.3% to 70 billion, up 691 million. The total value of owner-occupied housing commitments, excluding alterations and additions, rose just 0.1% in trend terms to 20.1 billion, up 26 million. Within the fixed commercial lending category, lending for investment housing fell 0.3%, down 44 million to 13.2 billion, whilst lending for other commercial purposes fell 2%, down 416 million to 20.3 billion. 39% of fixed commercial lending was for investment housing, and this continues to climb. Most of the investment housing was in Sydney and Melbourne. The more detailed housing finance data showed that the number of owner-occupied first-time buyers rose in March by over 20%. And that's a rise of 1,850. In original terms, the number of first-time buyer commitments as a percentage of total owner-occupied housing finance commitments rose to 13.6% in March from 13.3% in February. The DFA survey saw a small rise in first-time buyers going to the investment sector directly for their first property purchase. Total first-time buyers were up to 12.3% of all transactions, but still well below their peak from 2011, when more than 30% of all transactions were from first-time buyers. Many are being priced out of the market or cannot get finance. Lenders continue to tighten their underwriting standards for interest-only loans, with CBA, for example, ending discounts, fee rebates, and dropping the LVR to 80%, having in recent months imposed no less than 3 rate rises on the sector. ANZ tightened their lending parameters too, with the maximum interest-only period reduced from 10 years to 5 years. They tightened LVRs and imposed other restrictions. Overall, we think the supply of investor loans will reduce and that smaller lenders and non-banks will not be able to meet the gap. So we are expecting loan growth to slow further and the price of loans to rise again. We also saw auction clearance rates stronger last weekend. So this confirms our survey results that households still have an appetite for property despite tighter lending conditions. Recent stock market falls and greater market volatility will play into the mix now. So we think there will be a tussle between demand for property, especially for investment purposes, and supply of finance. Brokers may well get caught in the crossfire, and the recent UBS report suggesting that brokers are overpaid for what they do will not help. Others have argued that UBS got their sums wrong and denounced the report as ridiculous. It's still too soon to know whether home price growth is really likely to turn, but the strong demand still evident in Sydney and Melbourne suggests momentum will continue for as long as credit is available at a reasonable price. So I wouldn't write off the market yet. I'm Martin North from Digital Finance Analytics. Thanks for watching and check back next week.